Imagine a world where everyone is chasing the next big thing, convinced that missing out will cost them millions. That world is here, and it's called the AI boom. Investors, entrepreneurs, and ordinary people are rushing into AI startups, platforms, and applications, driven by hype, media narratives, and the fear of being left behind. But beneath the excitement lies a carefully constructed system designed to funnel money upward, create a bubble, and make participants feel like winners until it's too late. This is not a coincidence. It is a market engineered to capture attention, capital, and control. The AI frenzy has been fueled by a combination of government incentives, venture capital, and media amplification. Subsidies for AI research, tax incentives for tech companies, and public-private partnerships create an environment where startups can claim sky-high valuations even with minimal revenue. Venture capital firms and private equity funds have poured billions into companies promising revolutionary AI solutions. Each round of investment is marketed as a unique opportunity, creating a perception of scarcity and urgency. Investors fear missing out on the next transformative technology, often without fully understanding the fundamentals of the business. Media plays a central role in amplifying the AI bubble. Headlines touting breakthroughs, massive funding rounds, and supposed technological revolutions create a sense of inevitability. Social media platforms magnify the hype, with influencers, analysts, and journalists repeating optimistic narratives. This creates a psychological effect known as FOMO, fear of missing out, that drives investors to enter the market regardless of their knowledge or risk tolerance. The result is a flood of capital chasing a relatively small number of real, viable innovations, inflating valuations far beyond sustainable levels. Companies themselves contribute to the hype. Many overstate the capabilities of their AI systems, promising revolutionary changes in healthcare, finance, or logistics that are years or even decades away. Demonstrations are often curated, pilot projects are selectively presented, and technical limitations are downplayed. This marketing creates a perception that AI is not only indispensable, but also immediately profitable. Investors, eager to be part of the next technological revolution, pour money in, unknowingly feeding a cycle designed to enrich insiders first. The architecture of the AI bubble also relies on networks of institutional investors, banks, and tech insiders. Venture capital firms, hedge funds, and private equity collaborate with startups to structure funding rounds that guarantee early investors enormous returns if and when the hype reaches public markets. Employees, media figures, and consultants are incentivized to amplify optimism, creating a feedback loop that elevates perceived value. Meanwhile, retail investors and smaller participants are positioned at the peak of the hype, often buying at inflated prices just before corrections occur. Historical patterns reveal how bubbles are designed to trap participants. From the dot-com era to cryptocurrency booms, markets follow similar cycles. Early insiders accumulate wealth quietly, media and hype attract broader participation, and ordinary investors buy at the peak before the inevitable correction. AI is no different. The combination of technological mystique, venture funding, and media amplification makes it feel irresistible, creating a market environment where rational assessment is replaced by social pressure and perceived opportunity. As the AI bubble grows, the mechanisms designed to capture and concentrate wealth become increasingly clear. Retail investors and latecomers are encouraged to chase valuations, believing that entry is urgent and necessary. Yet, most lack the technical expertise or market insight to accurately assess company potential. Instead, they rely on media narratives, influencer commentary, and social proof, signaling that participation itself is a form of validation. This psychological manipulation ensures that new capital continually flows into the market, driving prices higher and reinforcing the perception of a boom. Institutional insiders exploit this dynamic. Venture capital firms, hedge funds, and tech executives often liquidate portions of their holdings at peak valuations, capturing enormous profits while retail investors are left holding shares at inflated prices. Structured funding rounds, stock options, and pre-IPO placements are designed to prioritize insiders and early participants. By the time the general public is fully invested, the risk of a market correction or technological setback is high, and the gains from the initial hype have largely shifted upward. Media and social amplification play a subtle yet powerful role in ensuring participants compete to enter the market. Headlines about breakthroughs, AI milestones, or once-in-a-generation opportunities create fear of missing out, pushing investors to make impulsive decisions. Online communities, social platforms, and investment forums amplify anecdotes of early success, giving the illusion that opportunity is universal and that anyone can profit. In reality, these narratives often serve as marketing tools that channel funds to insiders while reinforcing the bubble's momentum. The AI market is also vulnerable to systemic shocks. Technical limitations, regulatory scrutiny, or high-profile failures can trigger rapid declines in valuations. Unlike traditional markets, AI hype is tightly coupled with perception and trust. A single negative report or failed project can cascade into a broad loss of confidence. While early investors may exit with substantial profits, those entering during the height of hype often face significant losses, effectively becoming the market's losers in a system that was designed to benefit insiders. Despite these risks, the AI bubble continues to attract enormous attention and capital. Governments, corporations, and global investors are racing to secure a stake in AI infrastructure, research, and applications. The promise of technological revolution masks the underlying financial architecture that funnels wealth upward. Ordinary investors, motivated by greed, fear, or social pressure, become unwitting participants in a cycle that prioritizes the few at the expense of the many. The illusion of inevitability, the belief that AI success is guaranteed, ensures that enthusiasm remains high, even as structural vulnerabilities grow. Ultimately, the AI bubble exemplifies a modern pattern of market manipulation. Through hype, psychological pressure, media amplification, and carefully structured investment mechanisms, wealth is extracted from the masses and concentrated in the hands of a few. Retail investors, eager to join the technological revolution, often find themselves at the peak of inflated valuations, exposed to risk while insiders profit. The cycle is clear, and history suggests that bubbles, whether in .com, crypto, or AI, follow a predictable path: early enrichment for the few, eventual correction, and widespread loss for the last entrants. Understanding this system is essential to navigating the AI market wisely, recognizing that not all that glitters in technological hype translates into long-term value.